For several years now, I've been perfecting and providing legal advice by internet, and I've been able to serve people all over the United States and their counselors to increase their recovery of taxes for Ponzi scheme victims and for clawback victims. The Ponzi scheme victim will typically, from a tax standpoint, learn the words safe harbor once they start trying to recover their tax refunds. This is an IRS procedure that permits the average Ponzi scheme victim whose perpetrator has been charged in the criminal law system to have a very simple approach to obtaining their tax refund. A person who fits in the safe harbor should be in the safe harbor, because the alternative is a much longer process. However, there's so many victims who do not fit in the safe harbor, mostly because a lot of perpetrators of Ponzi schemes get prosecuted by the SEC and other authorities, but not by the criminal authorities. If you don't have the criminal authorities involved, the safe harbor is really not going to work. But there's many financial thefts that are still a theft and a tax deduction for IRS tax law. It's those people that don't fit in the safe harbor, and people who are making clawbacks, who fall in a different group. People who do not fit in the safe harbor and have had thefts from Ponzi schemes have a very, very good opportunity to recover the full refund, the same they would get under the safe harbor, based on the law. We are going to explore the law in this video. The people who have clawbacks also have a very special situation where they may actually be able to override the statute of limitations and go back and deduct their clawback income in the year they actually earned it, where maybe it was at a much higher tax bracket. We're going to explore that in this Ponzi scheme also. I hope this is going to be helpful to victims and their counselors alike. And I hope everyone can understand that I can be helpful no matter where you are in dealing with the IRS on this matter. We've done it several times successfully, and I'm open to all types of inquiries by internet if I can't help you, point you in the right direction.
Richard S. Lehman has over 35 years of practicing tax law in the United States. Mr. Lehman has had extensive experience with all areas of the Internal Revenue Code that apply to American taxpayers and non-resident aliens and foreign corporations investing or conducting business in the United States, as well as U.S. citizens and domestic corporations investing abroad. Richard has a national reputation for handling the toughest tax cases, structuring the most sophisticated income tax and estate tax plans, and defending clients before the Internal Revenue Service. Richard Lehman began his career in tax law with a law degree from Georgetown University, a master's degree in tax law from New York University, and 2 years of clerking for the Honorable William M. Fay, a judge on the United States Tax Court in Washington, D.C. He spent several years as the senior attorney of the interpretive division of the Chief Counsel's Office at the Internal Revenue Service, the IRS's internal law firm. Today, Richard works with other lawyers, accountants, business leaders, and individuals who are struggling to find their way through the complexities of United States tax law.
If you're a victim of a Ponzi scheme, you're going to be in shock for quite a while. Don't have being in shock prevent you from getting the maximum return on your money from the Internal Revenue Service in the fastest way possible. The purpose of this seminar was to try and make you aware of the options that you've got. A lot of people don't know that there's a good chance that their best source of recovery as a Ponzi scheme victim is not going to be from litigation, and it's not going to be from your homeowner's policy. The best source is going to be from the government of the United States. That's in the form of a theft loss, which will permit you to take an ordinary income deduction against your income with several benefits that go along with it. We're going to explore that theft loss in detail. The theft loss tax deduction provides the following. It's an ordinary income deduction used against all types of income that you might earn. It generally has a 3-year carryback to go back and recover refunds on taxes you've paid in the past 3 years. It may, this year, as it did for last year, permit a 5-year carryback of theft losses under certain circumstances. The law is still unsettled as to whether that's going to change for 2009. It's the fastest process that you're going to receive any kind of cash, because it's going to be in the form of a tax refund that under certain circumstances may go through very little auditing before the refund comes. And we'll talk about that later. It's got the best source of payment, which is Uncle Sam. It also, when you talk about the percentages of recovery, the recovery for every dollar that a Ponzi scheme victim has lost is 35% of federal tax, or can be that high. If they're in a state with an income tax, that can be anywhere from another 5 to 10%, which could bring it up to 45%. And the theft tax loss, we'll see, has other unique qualities that make it worth another couple of percent because of certain limitations it's not subject to. We're getting near 50% return on your lost dollar if all those things apply to you. And the theft tax loss has a 20-year going forward ability to deduct the loss. We may find with Obama taxation that we're way over the 50% return that you're going to get for your tax refunds from Ponzi scheme theft losses. So it's an asset that has to be given a great deal of care, and there is even the possibility of, under limited circumstances, of not just receiving your tax refunds, but receiving interest on the tax refunds that you get from prior years. So it's something that's got to be taken good care of. And you take good care of it with a professional product, with filing the right documents and the right support and having the right proof to show that you're entitled to every penny that you're entitled to under the theft loss deduction. We're going to talk about the law today. We're going to talk about the law, but the Internal Revenue Service, in response to the Madoff situation of so many thousands of people that were asking questions, has recently come out with something called a safe harbor, which means if your theft loss fits within certain qualifications and you're prepared to give up certain rights, you're going to be able to claim a Ponzi scheme theft loss without a lot of aggravation. You may not fit, and you've got to know what the law is first, because there's some strict rules to fit into the safe harbor that the Internal Revenue's offered. We're going to look at the safe harbor towards the end after we've discussed what the law is. But I will probably intermittently make reference to the safe harbor by way of comparison. The theft laws for tax law purposes is described in the cases and the regulations. And I'm going to read one definition that I think gives you a good feeling of what they mean by a theft loss for tax law purposes. What you will find is, the key to it is, a theft loss is whether any type of taking will qualify for any type of theft under state law. And that's a very, very broad definition. I'm going to read from one of the cases. For federal income tax purposes, theft is a word of general and broad connotation, covering any criminal appropriation of another's property to the use of the taker, including theft by swindling, false pretenses, and any other form of guile. A taxpayer claiming a theft loss must prove that the loss resulted from the taking of property that was illegal under the law of the jurisdiction in which it occurred and was done with criminal intent. However, a tax lawyer need not show a conviction or theft or even bringing of an action. Now, so that we don't get theft losses confused, we do know that there is some limitations to it, and that is the need for what we call privity between the victim and the defrauder. The best example of this is a theft loss from a purchase of shares relying on the market, relying on false representations of company officers. There is no direct relationship. The loss is on the market. The officers have no direct relationship with third-party shareholders. Without privity like that, we don't have a theft loss. The character of the theft loss is that it's an ordinary income loss. That means it has several qualities, all of which make it the most beneficial type of loss, since it's also considered to be a loss that comes from a trade or business. The different benefits of the character of the theft loss are, first, that it has generally a 3-year right to carry back. And as I mentioned earlier, this can extend to 5 years and may in fact happen in the year 2009. It also has a 20-year right to carry forward all of the unused theft loss. Furthermore, the theft loss has also the advantage of, as a business deduction, even the carrybacks that go back to the prior years are not reduced by the 2% limit on itemized deductions, nor is it reduced by the $100 reduction that comes from ordinary casualty losses. Furthermore, as a theft tax loss deduction, the deduction is not reduced by the application of certain percentage and dollar limitations that are applied to the certain loss deductions. The bottom line is you don't lose any of your theft loss deductions, either because you're reduced by a percentage of your income or any of the other limitations. The amount of the theft loss deduction is the next subject, and a very important one. It's important because we need to put to rest, first, any concerns about the concept of deducting taxes that you have paid on profits that never really existed, called phantom income. You are for sure allowed to deduct profits that you have paid income tax on that never were really there in a Ponzi scheme. And you're allowed to get the income tax back that's been paid on that. Amount of tax loss that a theft loss is entitled to is spelled out very clearly in the Internal Revenue Service rulings. And it's defined as this: theft loss resulting from a Ponzi scheme is 1, the initial amount invested in the arrangement, plus 2, any additional investments upon which taxes have been paid, such as additional investments you've made outside of the profits you've left there, and that amount is reduced only by amounts that have been withdrawn from the taxpayer's account. In other words, the amount of the tax loss is the taxpayer's basis in the money lost. Now, it covers phantom income, but it also means if you have income that was lost and you have no basis in it, you're not going to get a theft loss deduction. You're not specifically going to get a theft loss deduction from any IRA or deferred compensation plan where all the income that you put in and then was lost was never subject to tax. Neither the income you invested or the income, the phantom income that you received as phantom profits. So the amount is limited to basis. We next go on to the next important subject is the year of discovery. And that is, when is the theft loss deduction taken? It's taken in the year of discovery. The year of discovery is defined as follows: any loss arising from theft shall be treated as sustained for tax purposes during the taxable year in which the taxpayer discovers the loss. A loss is considered to be discovered when a reasonable person in similar circumstances would have realized that he or she had suffered an unrecoverable loss. It's very important to pin down this year of discovery. This is the year when you first can claim your loss. In addition to that definition, I'm going to discuss a few cases that will give you an idea of how this year of discovery, there's a method to its madness, but it's not that easy to pin down. For example, a loss was discovered in one case when a man entrusted property to an associate in year 1, made repeated efforts to locate the associate, and didn't go to the police until year 4, and didn't learn anything about his claim until the police investigation was finished in year 5, and he discovered that he was defrauded. The year of discovery was year 5, even though he was well aware of a lot of things that would put people on notice. At the same time, in another case, focusing on the year of discovery, a taxpayer bought non-existent land rights. There was no discovery when he purchased it, only when he couldn't sell it. The year of discovery was the year he couldn't sell it. The amount of the discovery of the loss that one takes in the year of discovery is a critical calculation, because you start off saying it's the entire amount loss. The entire basis is the loss in the year of discovery. However, the calculation does not stop there in the year of discovery. We're now going to consider the amount of the loss that one can take in the year of discovery when the loss is discovered. It's one of the most critical subjects of how to take advantage of the maximum tax refund. And the bottom line of it is, you start off being entitled to take your entire loss. However, in the year of discovery, that's limited by the amount that one believes there is a reasonable prospect of recovery, an undefined amount, a reasonable prospect of recovery. Whatever you do not have a reasonable prospect of recovery for, you're entitled to deduct in the year of discovery. If you have a reasonable prospect of recovery for funds, you cannot deduct that tax loss until later years. And what is very important is, when you try to deduct it in later years, while you'll eventually be allowed to deduct all of your tax loss, you can only deduct it in those years where there is an ascertainable standard that proves that you will not recover the loss. We're going to look at these items in a little bit of detail because it's important. The amount of loss that one can take in the year of discovery and the amount of losses that one can continue to take until all the loss is used up in the years after that. We need to start off at the reasonable prospect of recovery that will prevent the taxpayer from taking a theft tax loss in the year of discovery. The best way to get a handle on this definition is to look at the case law. One court has defined the reasonable prospect of recovery as follows. The court must determine what was a reasonable expectation at the close of the taxable year for which the deduction is claimed. The situation is not viewed through the eyes of the incorrigible optimist, and hence claims for recovery whose potential for success are remote and nebulous will not demand a postponement of the theft tax loss deduction. The standard to be applied is one of foresight, and we do not look at facts whose existence or production for use in later proceedings was not reasonably foreseeable at the close of the particular year. Nor does the fact of a future settlement or favorable judicial action on a claim control our determination if we found out that at the close of the particular year no reasonable prospect of recovery existed. Now, I will say, again, just referring briefly to the safe harbor, this standard has been made much easier under the safe harbor. We now have percentage amounts to define this standard a lot better when to be taking deductions. So, we have some feeling of the reasonable prospect of recovery. In addition to the general statements in the courts, in deciding whether there's a prospect for a reasonable recovery, there are also several principles the courts have established as guidelines. They are, 1, in determining the reasonableness of a taxpayer's belief of loss, the courts had to be practical and aware of the individual facts of a case. 2, the relevant facts and circumstances are those that are known or reasonably could be known as the end of the tax year for which the loss deduction is claimed. The only test is foresight, not hindsight. 3, both objective and subjective factors must be examined. And several comments about the effect of lawsuits that are brought in the year of discovery. And how much does that say that there's a reasonable prospect of recovery because of a lawsuit that will then reduce your ability to take your maximum tax loss in the year of discovery? There, the courts say, the taxpayer's legal rights at the end of the year of discovery are the all-important item and need to be studied to make a proper decision. One of the facts and circumstances deserving of consideration is the probability of success on the merits of any claims and lawsuits brought by the taxpayer. The filing of a lawsuit might give rise to an inference of a reasonable prospect of recovery. However, it's not conclusive. The inquiry is directed to the probability of recovery as opposed to the mere possibility of recovery. A remote possibility of recovery will not be a reasonable prospect of recovery upon which a deduction would be denied. Again, a couple of examples to show you how wide apart the courts can be on the term reasonable prospect of recovery. In 1979, Halliburton and Continental Illinois Bank had millions of dollars expropriated by the Iranian government. They had access to members of Congress, pushing hard for government action to get recovery from Iran or for the U.S. government to reimburse them. They had lawsuits of every manner, shape, and form. And in fact, they eventually recovered everything. However, the court at the time, looking in 1979, found that there was no reason to believe that a legal remedy existed for Halliburton and Continental. Without a legal remedy, they were entitled to their full theft tax loss deduction. Of course, they have to then, when they got their recovery, pay an income tax on the recovery. At the same time, another taxpayer was entitled to a theft loss recovery, even though he won a judgment against the other party in a lower court. When the tax court looked at it, the tax court said, even though you won a judgment in the lower court, we don't think you're going to win in the upper court, and therefore we're not going to say that you've got to have to wait to decide about anything, and you're entitled to your loss. And the man did lose in the upper court. So it's a pretty fluid definition within certain limits. We also talked about the ascertainable standard that one has to meet if you don't get your theft loss deduction in the year of discovery. I want to give you a definition of how you meet the ascertainable standard to give you a feeling for that also. The regulations are helpful in providing a definition here. The ascertainable standard is described as follows. When there is a reasonable prospect of recovery, no portion of the loss with respect to which the reimbursement may be received is sustained for purposes of taking the deduction until it can be ascertained with reasonable certainty whether or not such reimbursement will be received. A settlement of a claim, or an adjudication of a claim, or an abandonment of a claim is the type of ascertainable evidence that one will need in every year after the year of discovery to be able to establish that they can take their final deductions for the theft loss. We're now going to spend a minute on a series of cases that are in the courts, and it's all for a very wealthy taxpayer named Johnson. It had circumstances where the tax lawyers involved were always one step behind the right thing to do to help Mr. Johnson out. And that's why it's a good case for study. In 1997 in Palm Beach County, Aben and Joan Johnson discovered they were the victims of a fraud scheme involving the purchase of gems and jewelry in which they had lost approximately $78 million. The scheme had lasted from 1988 to 1997. During almost the entire time of the fraud, the Johnsons' income from their investments in gems was the repayment of their own funds that were paid previously to the perpetrator. Though the Johnsons discovered the fraud in 1997, they did not take formal actions against the perpetrators of the fraud in 1997. They did undertake an investigation in that year. The value of this theft loss was of a size to bring up every argument that we find, and it is a good case study for that reason. The lawyers for the Johnsons tried all of the following years to claim a theft loss deduction: 1997, 1998, 2001, and 2005. They weren't able to claim much of it, or any of it, until the year 2001, and had to leave a lot on the table until 2005. The major principle that we see in these Johnson cases, and in every case I've had so far, is that victims who want to take the maximum advantage of their losses must have a good professional product. They need a litigation lawyer, they need a tax lawyer, and they need an accountant who knows what they're doing. Because the secret to squeezing the most out of the theft tax loss deductions that can be carried backwards, forward, taken in the year of the loss, used against any type of income, is a professional product that shows you just where those tax losses can be best used, and shows you the legal direction so that you can take them in the years that you can best use them. There needs to be plenty of scheduling out of alternatives and options, and that leads to maximizing the theft tax loss deduction. That is what didn't happen in the Johnson case. 1997 was clearly the year of discovery for the Johnsons. In that year, the Johnsons' attorneys decided to claim the entire tax loss. Since there were multiple claims out there with no values that anybody had put on them, that was denied in full, saying nothing is deductible in 1997. You haven't ruled out anything. You've got enough lawsuits to make twice your money back. Then we moved to 1998. In 1998, there was a much better handle on what was really recoverable. However, 1998 was not the year of discovery. So in 1998, we have the year in which the standard is not whether there's a reasonable prospect of recovery, but we must have an ascertainable standard to show that there will not be any further recovery. Well, in that year, the Johnsons were advised to make real good estimates of what they were going to recover. No good. Matter of fact, the court even commented and said that what they used in 1998 may have been good for 1997, the year of discovery, but it was no good for the year after the year of discovery to meet the ascertainable standard. Finally, by 2001, they had gotten the message, came in with very, very detailed, proper studies to show exactly what would not be recovered, and were able to claim about 50 to 60% of their losses in 2001. However, keep in mind what happens when mistakes like that are made. It's 4 years of delaying the return of your cash. It's 4 years of lost income on the return of your cash. It's people who die in between and don't even get the advantage of the return of their cash. And it's changed tax situations where maybe you paid tax in the 35% or 45% bracket with state taxes, and now you're not making any money and your refund comes back in the 15% tax bracket. So these mistakes can be costly, and the Johnson case is a good example of it. Now, for the first time, I'm going to look at the revenue procedure and the safe harbor and talk about how it deals with the amounts that can be deducted in the particular years. The revenue procedure, I believe, can be very, very helpful in certain situations. A good example may be the alleged Rothstein Ponzi scheme. All of the litigation lawyers are talking about major lawsuits, major sources of recovery from all kinds of different parties. And based on the talk, it might be very hard to establish that in the year of discovery, and we don't even know that yet, which I'll discuss in a minute, but if 2009 is the year of discovery, and there's all this talk about great lawsuits and recovery, it may make it hard to take big tax loss deductions in 2009, for example. Now, the revenue procedure pins some of those things down. However, in order to take advantage of the revenue procedure, one has to meet all of the conditions of the safe harbor. I'm using those terms interchangeably, revenue procedure and safe harbor, but one has to meet all of those conditions. Some of those conditions of the safe harbor are not going to be easy to meet. We'll talk about them later, but for the moment, let's see what the safe harbor does to try to quantify taking losses. And it does a good job of it. The safe harbor divides losses into several different categories. First, losses that might be recovered from what the safe harbor calls the responsible group. That's going to be the Ponzi scheme perpetrator, the trustee of the Ponzi scheme perpetrator's estate, and certain parties related to the Ponzi scheme perpetrator or perpetrators. They're known as the responsible group. If you're going to sue and try to recover from the responsible group, and you fit within the revenue procedure, then you have to reduce the amount of losses that you're going to claim, i.e. the basis of everything you lost, by 5%, to take into account that you may recover from them. The second group of source of recovery that the safe harbor looks at is what they call the potential third-party recovery. And that means anybody not in the responsible group, that's third parties, but not things that have any type of a guaranteed recovery, things that are going to require lawsuits, that kind of stuff, such as brokers that might be involved or banks that might be involved. That type of thing is what fits into the third-party recovery group. Now, if you're going to also have recovery from the third-party group, and you've got lawsuits going and what have you, then you can only take 75% of your loss in the year of discovery. Now, This is a very helpful safe harbor, because without the safe harbor, you're relying on the law. Relying on the law, we have got to come in and do a lot of very good proof to show that you're entitled to 75% of your tax loss in the year of discovery, especially when you might have 10 lawyers working on lawsuits, all claiming that they're going to get you everything back. So this is where fitting in the safe harbor is a very helpful thing. Now, the safe harbor doesn't stop there, though. It deals with the responsible group. It deals with third-party claims. And then it makes two further reductions to determine what you cannot deduct in the year of discovery from the total amount. Your total amount is reduced by what are really in the nature of insurance recoveries, insurance policies that will pay, contractual arrangements or guarantees or stop-loss situations, any type of product that protects against the loss of the Ponzi scheme investment, that also must be deducted as a reasonable source or prospect of recovery. Anything that fits into any of those insurance stop-loss type agreements, you cannot claim a theft loss in the year of discovery if you've got reimbursement potential there. Finally, there are certain amounts that you may receive from the Securities Investors Protection Corporation, since those type of claims from administrative authorities or government authorities, they often will have an amount that you can get but may not get in full. You have to claim the full potential amount that you can get, and then wait to see what the actual repayment may be to claim any balance. We're now going to move on to the one viable alternative to the theft loss deduction. By filing an amended return and eliminating only the Ponzi scheme income, the taxpayer will be eliminating the high tax bracket income. However, when the taxpayer uses the full theft tax loss, instead of just the loss attributable to the Ponzi scheme, the taxpayer is not getting a full return of their taxes. I'm going to give you a very simple example. Assume a taxpayer has made $1 million from a Ponzi scheme, all of it in their highest tax bracket of 35%. That means the taxpayer will have paid $350,000 on their Ponzi scheme income. If that taxpayer is allowed to file an amended return and eliminate all of that Ponzi scheme income, the taxpayer is going to get back $350,000. However, if the taxpayer cannot file an amended return and eliminate that income from his taxes, he then instead will take a theft loss deduction. When the theft loss deduction is used to go back into prior years, some of that deduction will be used against lower tax bracket income, ranging from tax brackets of 15% up to 35%. Therefore, when compared to using the amended return, the taxpayer will typically receive a much lower amount from a theft tax loss refund than they will from claiming the same amount on an amended return as income that should have never been reported. Now, the Internal Revenue Service, of course, frowns on this. However, they do seem to accept it because they mention it in their statements of the law on Ponzi schemes, and do everything they can to try to encourage people not to do this. It's also important to note that when you file amended returns and eliminate the income, as opposed to filing a theft loss return, the refunds that you will get will carry interest from the years where the income was eliminated. So you will get refunds plus interest from IRS on those years when amended returns are accepted. Finally, we come to the last principle that we need to discuss, the principle of clawbacks. What happens in Ponzi schemes is that certain parties, either intentionally or unintentionally, actually may make out very well in a Ponzi scheme, receive all of their money back or even receive a profit and not go back into the scheme, and others may have lost all of their money. Under legal situations that I'm not going to discuss in full, the trustee of a Ponzi scheme in bankruptcy, let's say, is able to pursue what's called a clawback, go after the participants in the Ponzi scheme that really may have received something unfair, and take that money back to put it in the pot for the other Ponzi scheme victims. Now, clawback can come many years later, and what will typically happen in a clawback is if you have to pay the clawback, then you'll get a deduction for the money that you paid to make the clawback payment. However, if you're like many Ponzi scheme victims, and in those later years you're not making any money because you've lost most of your principal, the tax benefit from paying that clawback amount could be very little. If you're in the 15% tax bracket, you're only going to get 15 cents on a dollar. There is a code section that would allow you, in the event of a clawback, to go back to the year in which you earned the money that you're paying back. That's typically going to be high-earning years, and under those circumstances, if you are allowed to use that code section, you're going to get a bigger bang for your buck when it comes to the tax refund percentage. And again, you're going to get interest from the Internal Revenue Service for those prior years. This is one of the rights, along with the right to make an amended return, that the Internal Revenue Service is going to ask you to give up if you want to fit into the safe harbor. Finally, let's consider the rules that govern trust in estates. It's three very simple principles. If the theft occurs while the decedent is still alive and it's discovered during the estate administration, only an income tax deduction is allowable to the estate. There's no estate tax deduction for losses that occurred or occurred during estate administration. If the theft loss occurred and is discovered during the estate administration, the estate can take an estate tax deduction or an income tax deduction. If the theft loss occurred after all the estate accounts have been distributed, the estate takes no deduction and it's in the hands of the beneficiaries. Finally, let's talk about the revenue procedure and how it compares with the law that I just described to you. The treatment of the Ponzi scheme is compared under the safe harbor or the revenue procedure and the law or the revenue ruling issued by the Internal Revenue Service. And we'll walk down that quickly. The Ponzi scheme loss is a theft loss deductible as an ordinary loss. The revenue procedure acknowledges that, and the law certainly acknowledges that. However, the revenue procedure has a very limited definition of theft loss, and it requires a lot more to fit under the revenue, under the safe harbor, and be considered a theft loss for purposes of using the safe harbor than it does under the law. This is typical for safe harbors, since they are only allowing you certain benefits so long as you're not even asking for as much as you're entitled to under the law. The second principle is that the amount of the loss is the basis. This is recognized both in the safe harbor and under the law. Phantom income, taxes on phantom income can be recovered. The next item is the 3-year carryback and the 20-year carry forward, recognized in both the law and under the safe harbor. Where there's a difference is how much can be deducted in the year of discovery. And that's where we had the long discussion showing you that the revenue procedure has got this down to percentage amounts, whereas the law will be requiring proof. Now, you may be able to include to do much better than those percentage amounts. If you're in a Ponzi scheme and there's really nothing much there by way of third-party recovery, then and you have only one small recovery that's not going to get you 20% recovery, you may want to not use the revenue procedure and come in with proof that shows that you're entitled to much more than 75%. But the revenue procedure helps in not having to prove up losses. The parties all agree, the law and the revenue procedure, that the theft loss should have all of the benefits of not having any limitations on its deductions. Both the law and the safe harbor agree that if you weren't directly invested in a Ponzi scheme, but you were invested in a partnership or a subchapter S or a limited liability company or any other type of company that was a see-through tax entity, and you were getting your own separate statements from the Ponzi scheme, the law and the safe harbor recognize that you're entitled to the benefits. However, the safe harbor recognizes only that you're entitled to those benefits indirectly, not directly, which means if you're in a partnership that does not elect at the partnership level to take advantage of the safe harbor, even though you as an individual partner want to take advantage of it, you're not going to be able to. The revenue ruling and the safe harbor differ on the year of discovery. The safe harbor requires the year of discovery to be the year in which there's an indictment or a trusteeship where there's specific, very hard and fast things to show that there's been a theft. That's the year of discovery under the safe harbor. And this is where people may have problems. Under the law, the theft can be shown in many different ways, so long as it is going to be a theft for state law purposes. As we also talked about, the safe harbor is going to ask you to give up your right to file amended returns, give up your right to take clawback paybacks in the year that does you the most good, The law allows you all of those things. The safe harbor, you won't receive interest on your refunds. Under the law, under an amended return, you are going to receive interest. And finally, the IRS does state you're going to have an easier ride from an administrative standpoint if you choose the safe harbor, and you may not if you choose to go under the law. Finally, let's talk about tax planning. There's myriad options here, and people need to know them all. In an estate situation, there is potential to lose tremendous amount of money with loss carry-forwards that can't be used. In the income tax situation, just the year of discovery is going to make a difference, and when people can get their money, how they can get their money, whether they get their money in interest, whether they get their money back at the highest tax brackets. You need to know all of your options. That's the heart of the tax planning. You need to have your crew of professionals so that you can scope out in numbers and in hard dollars every option that you've got and be able to choose the best ones that have the quickest legal answers and the best financial answers for you. And I want to stress that at any time I'm open for questions. It's all the information is available on the website. I hope this has been informative. Thank you. We're going to discuss a subject that flows automatically from the Ponzi scheme, and that is we're going to talk about what's known as a clawback. Most of us are familiar with the Ponzi scheme by now, and we know how people can lose a lot of money and at least get their money back by a tax refund, by a deduction. The clawback is what goes into effect when the Ponzi scheme crashes and a trustee is appointed to gather whatever assets are left of the perpetrators and of the Ponzi scheme, and then try to deliver some type of equity to the all of the people who were involved in the Ponzi scheme. That winds up meaning that some people who were in the Ponzi scheme and may have made money are subject to having to pay back some of that money. The term clawback is used to describe the power that a trustee has to regain assets of a debtor that should have been available as part of a bankruptcy estate, but they were removed or hidden from the trustee by the debtor, not the investors in the Ponzi scheme, but removed by the perpetrators because of a preferential transfer or a fraudulent transfer. The trustee has all kinds of powers to recoup certain funds. I'm not going to go into a real complete study of the clawback, but suffice it to say that when someone has a profit from a cash flow basis on their investment in a Ponzi scheme that crashes, that profit to a certain extent could be forced to be repaid as a clawback. The example I give is Mr. Jones, who invested $1 million in a Ponzi scheme and earned $1,500,000. Let's assume he paid tax on it of $500,000 and then spent the other $1 million. The Ponzi scheme then collapses. Mr. Jones loses his $1 million Ponzi scheme investment. Therefore, he's still made $500,000 from that Ponzi scheme from a cash flow standpoint, even though that 500 went to pay taxes. It still was distributed from the Ponzi scheme. So even though the investor may have to pay back those monies that he received in profit that were not profitable in the end, that's the situation he's going to be in. Now, tax law tries to ameliorate some inaccuracies that result from having a situation like this where a Ponzi scheme investor winds up not only losing money in a Ponzi scheme, but paying money back to a Ponzi scheme for others to have a little more equity and divide up. The main inequity from a tax law standpoint that can be caused by a clawback is the following. What if you received money from a Ponzi scheme in the year 2006 that you reported as income? And what if you were in New York and you paid a total of 45% taxes on that Ponzi scheme income in 2006? Now it's 2011. You've got to make a repayment of a clawback amount. And if you deducted that repayment in 2011, you don't have any income left. You've been wiped out by the Ponzi scheme, let's say. And so consequently, the deduction has no value to you in 2011, or only a value at a reduced tax rate. This is cured sometimes by what's called the mitigation section in the Internal Revenue Code. And it comes under Code Section 1341 of the Internal Revenue Code. It was designed to allow someone who pays funds back in a clawback to at least be able to go back to the year that the clawback income was made and calculate which deduction would be more valuable. Taking the clawback in the year of the higher tax bracket, which is generally always going to be the case, let's say 206 in our example, or taking it only as a deduction in the year of paid, or 2011 in our example. Since this is a beneficial section for the taxpayer, the IRS really is very strict about making sure one qualifies for what this was intended for. We have a lot of guidance in this area, not just from the Internal Revenue Code section, which has been in existence for quite a long time, but we also have guidance from two companion cases that were decided in 2004 and 2008, where first the Pennzoil Company was permitted to use this mitigation section when they had to repay certain sums that after the year 2004, but wanted to treat those sums as being paid in 2004. The first court that heard this case found that the Pennzoil Company was entitled to this mitigation section. This opinion, however, was overruled, and these two Pennzoil Quaker State cases, 2004 and 2008, because of the nature of the cases, they had to thoroughly explore every requirement of these mitigation section, and they've been able to give us some good guidance. The reason, to go back, that we needed the mitigation section was because of something called the claim of right doctrine. That meant that if a taxpayer received income in a particular year, 2006, going back to our example, but was forced to repay it in another year, the taxpayer still could not go back to the original year and change that. The original year most often was closed by the statute of limitations, and it was impossible to do so. This claim of right doctrine resulted in the inequities of only getting a tax deduction from a refund of monies that were taken into income in the year of payment, and, as we said, was cured by the mitigation section. The mitigation section has 5 important requirements. There must have been an item of income. The item of income must have been included in a prior taxable year. Secondly, because it appeared that the taxpayer had an unrestricted right to that item of income. Third, the taxpayer must, in order to use the mitigation section and go back to a prior year closed by the statute of limitations, the deduction that the taxpayer is claiming must also be allowable for the year in which the money was paid, was repaid, so that a deduction must occur and be allowed in the year 2011, in our example, if it's also going to be agreed to in the mitigation section as deductible in the year 2006. The fourth important requirement is that it must be established after the close of the prior taxable year, 2006, that the taxpayer did not have an unrestricted right to the income that was refunded. And finally, the only thing that's not argued about continually is the fifth requirement, that the amount of the deduction must exceed $3,000 if one is going to use the mitigation section. What we're going to do now is explore each one of those 4 important items and consider them in some detail. The first requirement for mitigation is that an item of income must have been included in gross income for a prior taxable year or years. Both courts in Pennzoil had to address this issue of whether an item was included in gross income. Now, in the Pennzoil case, eventually, for several reasons that we don't have when we're dealing with Ponzi schemes, Pennzoil was ultimately not allowed to use the mitigation provisions. However, the explanations review of the law in the area by Pennzoil is excellent. Now, in the Pennzoil case, which ultimately ruled that the taxpayer, Pennzoil, was not entitled to use the mitigation section, we first need to consider whether an item of income has been included in gross income by the taxpayer in the previous year. The word item, we have plenty of guidance on it, because right in the Internal Revenue Code there is a specific definition of the word item of gross income. And certain specific items are listed. However, that definition is not limited just to the specific items listed, because it includes all income from whatever sources derived. And then it goes on to list some of those sources. And these include things such as interest, rents, royalties, dividends, income from business, income from selling, dealing in property, annuities. The list of income items, however, doesn't really complete the exploration that's needed to see whether a certain required income item is included in gross income. Here, what the courts have tried to do is make sure that if one is going to use the mitigation section and get a deduction for an item paid in a later year, that there is an absolutely close, that there must be a close relationship between the item of gross income that's originally recorded and the item of gross income that's being refunded. The Pennzoil case ultimately found that since that there was no item of gross income, the Pennzoil case decided that the item of gross income reported by Pennzoil in the earlier year was not related to the item that was refunded as a result of the Pennzoil settlement, and therefore held that there was no item included by Pennzoil, and Pennzoil was not entitled to the mitigation section. The Pennzoil rationale is not very well handled here, and actually confuses things. There is a dissent in that case. The better rationale is the second part of the second Pennzoil opinion, which holds that the reason that Pennzoil was not allowed to have the mitigation provisions is because the item that Pennzoil was considering dealt with Pennzoil's inventory. And there is a special exception that says that the mitigation provisions cannot apply to inventory items, since they have their own unique way of calculating profit and loss. The Pennzoil court, though it did not do a good job of saying why Pennzoil was not an item of income, did do a very good job of explaining the rationale behind this same circumstances test. And the Pennzoil explained that rationale as found on chart 6, that there are limitations to the section 1341, and those limitations are the necessity to have this direct relationship between the item of income and the refund. The second part of this first requirement for mitigation is that the item be included in gross income in a previous year. This second part of the requirement, at least, is one we don't have to struggle with, because the item is going to be included in gross income, or it isn't, and it's going to show up in the tax returns for the year in which mitigation is being sought, if it was included. The second major requirement to make use of the mitigation provisions is the requirement that it appeared, and the emphasis is on the word appeared. It appeared that the taxpayer had an unrestricted right to such income. Here, the code section is mainly trying to distinguish between taxpayers that appear to have a legitimate right to unrestricted right to gross income, and pay the tax on it. And taxpayers who really had no actual right to the gross income that they may have reported in prior years, because there was the income that they received was received from a claim was wrongfully obtained. This is known as the claim of wrong exception to the mitigation provision that comes under the claim of right doctrine. There are several examples of this claim of wrong exception where a taxpayer is not entitled to use the mitigation provisions and go back and deduct income from a prior year. These are things such as embezzlers who have included income in their tax return, smugglers, kickbacks, and other ill-gotten gains. On a very limited basis, you may find a case or two where there is a civil fraud setting and the 1341 is not available. However, it should be clear to everybody that the Ponzi victim who is suffering loss to begin with and now is subject to a clawback also is not an intentional wrongdoer as to items of income as a general rule, absent some serious fraud. This is an individual who has invested money with every intention of making a profit, does so, and that's the reason that a clawback is now in force. The third requirement for mitigation is that a deduction must be allowed for the taxable year in which the item is repaid. This is another example of the technical requirements of using the mitigation section. The requirement is that a taxpayer must be able to obtain a deduction for the year in which the Ponzi scheme loss is discovered. And very often you will run into a situation not as clear-cut as the Ponzi scheme, but there is a requirement that there must be a deduction in the year that the payment is made if the mitigation provision is going to permit that same deduction in the prior year when the income was included. Now again, this is going to be affected by that claim of wrong exclusion. However, the claim of wrong exclusion and the right to a deduction by a Ponzi scheme victim really should not be open for question anymore. The reason it should not be open for question anymore is because the Internal Revenue Service, in one of its very important rulings in 2009, found that a Ponzi scheme victim is entitled to a theft loss deduction because a Ponzi scheme is an activity that is entered into for profit. Whether a loss from a Ponzi scheme is deductible has already been decided by the Internal Revenue Service. In the year 2009, the IRS, in response to all of the pending claims for refund generated by the Madoff situation, produced two public documents, a revenue procedure and a revenue ruling. These documents made it clear that victims of a Ponzi scheme are entitled to a deduction for their loss relating to that Ponzi scheme. Now, since this loss from a Ponzi scheme is no different from the ultimate loss that one who is subject to a clawback will realize. There should be no reason that a clawback is entitled to a deduction on the same terms as a Ponzi scheme loss. Therefore, the Internal Revenue Service itself seems to stand for the proposition that a deduction for a clawback is entitled for the year that the clawback is made. Now, we cannot talk about the deduction of the clawback without also discussing one of the documents produced by the Revenue Service in 2009, known as the Safe Harbor. The Safe Harbor was in the Revenue Procedure 2009-20. The Safe Harbor allowed people who had suffered Ponzi scheme losses to have an administrative, easier route without audits, etc. And if they applied for their refunds and met certain conditions laid out by the Internal Revenue Service, that would let the service know for sure that they had legitimate Ponzi scheme losses. Now, what is interesting is that the Internal Revenue Service requires, if a person uses the Safe Harbor, that they waive any right that they have to use the mitigation provisions of Code Section 1341. The Internal Revenue Service, in their ruling, gave some reasoning to back this up. The reasoning, however, seems to justify that a direct Ponzi scheme loss is certainly not entitled to the mitigation provisions because nothing is paid back. However, an actual Ponzi scheme refund is a repayment that would fit into the deduction requirements under the mitigation provisions, since it is a deduction that arises because of an obligation to restore income. Consequently, any taxpayer who is going to use the Safe Harbor, who also knows they are going to run into a clawback sometime in the future, needs to study very carefully how much this might affect their bottom line when they give up the right to use the mitigation provisions with their clawback and have to deduct all of their clawback money only in the year of payment. The final requirement for a clawback mitigation deduction is a fourth requirement, that the funds that are restored by the taxpayer must be restored because it was established after the close of the prior taxable year in which the income had been included. This is principally a requirement that's been imposed by the courts to make sure that repayments of taxable income are not repaid voluntarily just to be able to take advantage of the mitigation provisions of Code Section 1341 and take deduction in a year that they would not ordinarily be able to take a deduction. Therefore, the taxpayer must establish that they did not have an unrestricted right. This is generally going to be established in the Ponzi scheme because the trustee is going to send out a lawsuit. The Ponzi scheme victim, the subject of the clawback, is typically going to fight that lawsuit and typically there will be a settlement. The fact that a payment cannot be voluntary is satisfied under the law if there is a good faith, non-collusive settlement agreement entered into to terminate litigation that establishes the liability to refund the income. There are several cases were analyzed by the Ponzi case in giving guidance on this, and distinction was made between that situation in which there is a legitimate legal dispute and a situation where a taxpayer returned funds in order to protect his reputation and not as a result of any type of legal dispute.